Hi,
Good morning.
good morning. We are live. And the funny part about this, Jim, is we are actually in the same room facing each other for the first time. Like if I stick my hand over and shake it, you're there and I'm here. We're actually having a conversation.
Yeah, this is kind of weird.
No, I think it's modern. Like we're in a podcast and we're working on our game. The question is, are y'all working on your game and learning how to use video in your business and incorporate conversations and podcast style content into your business plan. So it doesn't have to be perfect, as we've learned this morning. We probably could use a little lighting, but we're here and it's our Monday morning industry update. I'm excited. Let's rock and roll. All right. So Jim, what do we feel out there? Like, give me the feeling before we look at the data.
It feels weird. And I think it feels weird because we're still trying to adjust. We're trying to adjust for a summertime that was really weird. And so our summer sales were definitely down, but we've started leveling off and things are actually a lot more normal than they actually feel like. It's just we came out of a couple months and where we're adjusting the interest rates and therefore the prices were adjusting. So we are adjusting our business and what we were doing on putting together our listings. And I think sitting right now, instead of it just feeling like a kind of a normal September, there's a lot of news that's making us a little worried. And it just makes it feel that much slower just because of what the summer felt like.
Absolutely. And what I'm hearing you say is like we've made mention of this quite a few times on this call, is the pendulum swung to excess. And the pandemic created that. You could say some of the government stimulus created that. You could say it doesn't matter what created it. We lived in a period of excess, and that pendulum is swinging back to normal, not necessarily the opposite direction, but back to center. And, you and I've talked about like, hey, what's the trend line really? Like if we took the excess of the pandemic off the table, where do we look at historically in the trend of where the real estate industry was pre-pandemic? So if you go back to 2017, 18, 19, what was that trend line looking like pre-2020 and 2021? We actually feel really good about the trend line of where we're going. It just feels weird, to use your word weird, because we're coming out of excess, right? Like it's just a matter of stretching the rubber band and then going back to normal. It takes a minute to feel like a normal position.
Yeah, well said.
Yeah.
Gary had a really great slide at Mega Camp, and I think it'd be worth posting it out there. And it was just kind of the cycle of in real estate, and where we have a market that's up, to the journey back down, to the journey back up. And he said, look, y'all, according to this, we are on the way down, but we kind of feel like it's going to be a short ride down. And so when you look at the years that he had put on each one of those lines, it really makes sense that as we're going through this next year, kind of plan on being in that trough area, right? And then hopefully, never know what's going to happen in the news, but we have that rebound back up.
Yep. And another talking point that I think is worthy of mentioning is we've made mention, again, we live in a major metropolitan area. And when economic shift change happens in the US economy, the major thriving metropolitan areas are usually the last to be affected and the first to recover. And we're seeing that. Like we're seeing parts of the country that's really struggling right now. Not a lot of the country, but there are pockets of the country. Certainly the high dollar, high unaffordable markets like a New York, a California, they're hurting right now. I think you're going to see some of the economically depressed areas that are hurting a little bit right now, but that's not us. And I think that's the worthy of the mention at the very beginning of this call is, we're committed to bringing you all news, not just the fluff. So this is a real conversation, and some of it's positive, some of it's negative, but it doesn't necessarily always affect us. And we need to be really clear, like, what's our market? Because our market is not exactly the same as everybody else's market. So let's jump in real quick. So 188 active listings. If I just go back to this chart, back in May, we were sitting at like 120 and we were crying we had no inventory. And we went up. We actually came back down in inventory a little bit. Now, could that be seasonality? It could be. Could it be a tightening? Here's the bigger number. What's the gap between these lines? So when we're low in inventory and there's not a lot of room between the inventory and what's selling, it just tells us that the market's really tight. But you can see we're lower now than we were here. We got a pretty good size gap here, which tells me from a supply and demand perspective, that gap would be supply, right?
Yeah.
And these lines down here would be demand. So we're seeing that shift, if you will, to more supply, less demand, which is going to move the pendulum out of that acute seller's market more towards a more balanced market. But kid you not, we are not in a buyer's market. I think we like to think we might be, or we want to convince ourselves that we are, because that feels good coming out of what we came out of, and we want to go win with our buyers. But it's still a seller's market. What do you think?
Yeah, definitely still a seller's market. I think we were in a temporary buyer's market, and I use temporary really strongly, meaning for about 2 months. And what happened was, and this is, I've got a good sound basis for this. We had so much inventory come in all at once in those couple months, and there's no way that our demand could keep up with it, which created this artificial temporary buyer's market. And that's where we've started seeing prices come down. Now, if you start looking at the days on the market, and you need to track what are the active days on the market, active option, pending, last 30 days sold, they're all starting to be right about the same. We had this big disparity where active option, we were at about 17, 18, 20, and we're starting to see everything come together right around that 30, 35 days right now. So it's all kind of leveling off, which means the market's about to have a little tiny shift back to it.
Yeah. And at the end of the day, on this call, it wasn't how long ago we were screaming, get your buyers in the car, go back to your pipeline, get them going, because the market moves that fast. And that temporary buyer's market you're talking about, what time frame was that? 30 days, 45 days, maybe?
Yeah.
So plugging into this call and catching the numbers when they're happening could put a lot of money in your pocket if you listen to us. All right. So just to kind of run through them, 27 active option, pretty consistent with what we've been doing. Pending's at 40, maybe a little off on pending. Not much, but if we're looking at averages, we're probably okay here. Sold's 37, 2 weeks in a row we've sold 37. End of month here, I'm seeing us being off on sold. I don't know if that's 20% or 15%. I'm not prepared to quote a actual percentage yet, but it's definitely more than 10% off on closings at the moment. That's Rockwall County. Dallas County, same conversation. 1176 active listings right now, 350 active option, 429 pendings, 421 sold, which they had an off week last week, which coming off the holiday we talked about. But see what I mean in the number? It's real hard to predict. Are we down 15%? Are we down 10%? It's hard to predict that at the current moment. But if you just look at September compared to what August was, I bet you at the end of this month, we're going to show that we were down probably a little bit. So we'll see. And we'll bring that information to you. but it's worthy of looking. If you just look at the chart, the gap here doesn't look much greater than the gap here did from a supply and demand perspective in Dallas County. So I'm not sure there's a lot of shifting going on from seller to buyer, buyer to seller. It's just kind of holding in that same space where if I pulled this chart out further to the left, these lines were crossing not a year ago, right?
Yeah.
So it's important to kind of watch from an active inventory versus what's selling. Kaufman County, we can just look at the lines here. Inventory's going up, gaps holding. As far as these sold is the green line, Kaufman County bounces around a lot, but it seems to stay just under that 100 mark. So pretty balanced there. Collin County, climbed, came back down, seasonality, same kind of conversation as Dallas County, but the gap's pretty good. If I just look at the actual numbers, 860 active listings, 204 option, 278 pending. That's a pretty somewhat healthy number for Collin County. 259 sold. Same kind of analogy. If this was September trending, what did August look like? I mean, I don't know. We may be down a little bit. We may be just down a tiny bit. Let's see how the numbers pull out, but we're holding there. And then if I jump over to the lake, 67 active, looks like that end of summer inventory is starting to taper off just a little bit. Option contracts 19, people are still buying. Pendings 27. It's almost the highest number out in Henderson County. And then of course, 24 closed. I mean, these are some healthy numbers out at the lake. If you do the same exercise, what's that, 4367 month to date compared to 50, 65, 91. I don't know. We'll see at the end of the month, right?
Yeah.
But the other thing I want to just run through real quick, Jim, and look at is expireds. So I'm not seeing an uptick here in Henderson County. I'm not seeing an, come on, fingers. I'm not seeing an uptick in Hunt County. Bigger counties, I'm not really seeing a big uptick in Denton County. Maybe a little bit at the end of August. Collin County, expired listings, 16, 27, 65.
Yeah, again,
I'm not
right there at
seeing
the end
it.
of August, just a slight blip.
Yeah. And then if we run over to Rockwall, 3,
Yeah.
I mean, that's not anything to write home about. So what do you make of this?
Yeah, well, to go back to what you were talking about a little bit ago on what are we really seeing, I think going back to the excess conversation earlier, we are going to see about a 15-20% dip from where we were. But if you look at the pre-pandemic numbers, we're going to end up right where we typically do in September. Like I said, it just is a different feel out there because we've been in this go market and we are down 15-20%, but that was just unrealistic expectation of what we should and just what we should be doing.
Yeah, absolutely. Let's jump over here and look at this for a second. So this is a screenshot of market news, which is really a news media around the stock market. And all of a sudden, somebody said our Facebook Live video ended. I don't know what that means.
Yeah, it still shows live.
Huh? Are we still, it says we're live. I don't know. We'll keep going. If not, we'll post a recording. How's that? All right. So Market Watch posted this and it all of a sudden it upgraded all the production builder stocks. And what overweight means says it's now a good buy according to analysts. So I find this really interesting because most of the media we've put on this call or watched said builders are tightening. They're not putting in as many permit. What do you make of this?
Yeah, I think it's like anything else, it's just a speculation look at, but we've seen builders definitely pull back and they've seen demand change in their market. And I think we're all looking at this from a perspective of there's still a demand for new builds. That hasn't gone away, it hasn't changed. And so I think as we're going into this next year, we're going to see new builds go back up again. I read something, I don't know, over the weekend, and it talked about right now there's more starts in the DFW area than there was all through the pandemic at any given one time. So they're starting to put back into production. And I think they've also kind of figured out the puzzle. I'm starting to see the builders advertise, hey, here's our open inventory. If you'll buy this, we'll buy down your interest rate to 3.5%. Been seeing that a lot lately.
You know, I think this is a ode to business.
Yeah.
And I think the builders in the previous Great Recession learned how to be business owners and learned how to make profit. And they learned how to cut expenses and they learned how to margin their business. And what I think this really means is, hey, they're in it to win it. They're going to learn, they're probably going to build less houses, but from a stability, from a quality, from a delivery perspective, I think the builders are going to do just fine.
Oh, yeah.
And I think that's really strong for our industry, meaning not great that they're going to build less houses, but we're not going to have a bunch of builders going belly up like we did in 2010. And the analysts understand that these builders are on top of their business and moving accordingly with what the economy's doing and what supply and demand's doing. They're probably studying their numbers like we are. I think it's really strong. Let me get off here. All right. So I found that an interesting topic, of course. All right. Tell me about this article. So this is the 7 things elite real estate agents do that you probably don't. Now, I'm assuming there's some secret sauce and some earth-shattering information in this article, Jim.
There absolutely isn't. It's
Yeah.
It's everything you've heard from the first day you became a realtor and you went through Ignite and you heard all this. And it never ceases to amaze me that we never pick up on what we should be doing. But the one that I love the most, and because I'll tell you, anything that Patty Turner does, anybody out there can replicate. What it comes down to,
don't tell her that.
she'd hit me. No, what it really comes down to is the very last point in here, and it's the point that you can't teach.
Yeah.
Well,
let's run through these real quick.
Yeah.
So they track their numbers. We track our number. We're here every week doing this, right? Like, you should be in tune with the market. It just goes back to that conversation we just had around that 30 to 45 day brief opportunity to put buyers into houses. If you were tracking your numbers, you'd be on it, you'd go take advantage of it.
Yeah. And as we're entering into this business planning part of our year, you need to have that in the back of your mind, because as you put together your business plan, you need to have also this kind of alternate business plan of, all right, what if the market goes down a little bit more than we thought? What are the levers that I'm going to pull to work past that? It's all it is.
Absolutely.
But you got to watch the market numbers.
They reinvest back in their business. We've talked about what's the difference between an expense and an investment. You know, an investment has a return. I spend $1, it makes me $4 in revenue. So what they know is they don't get scared and start cutting off the investments in their business that are causing their business to continue to thrive. And quite honestly, it actually works to their advantage, because everybody else that gets scared cuts it off. So then it actually creates their return higher because less people are in the space. But I'm not saying be irresponsible with your money. I'm saying be highly responsible with your money and hold it accountable, but be careful not to stop spending on your business, which is the one thing that's causing your business to continue to roll. Time block. Why is this a dirty word?
I don't know. I've got a book in my office that's all about this, but it's not quite about this. It's all about hurry. And it's pretty ingenious, the different ways he comes up with time blocking, but everybody just shudders at it.
You know, I find it interesting because I probably fought it early in my career too. But if you guys notice, we're here every Monday morning at 9 a.m. and we go live exactly at 9 a.m. barring any technological issues. The only way that happens is our schedules are time blocked. I mean, here's how this happens. Jim and I start texting articles on Sunday afternoon. Hey, this is a good one. Read this one. My cyberbacker updates the spreadsheet on Sunday nights. And so the numbers are done and everything is scheduled and time blocked. So honestly, this is a big conversation, but how much preparation do we really have to go into this conversation because we're time blocked? Like it takes out the thinking.
Yeah. And it takes out the hurry and the worry and everything else that goes along with it.
They study their local market daily. It's a thing around the numbers, right? I think that's really important. They consistently communicate with other top agents. If you find yourself on an island in real estate, you're on the wrong island. Like you should be in dialogue with other people in the market. One, just to be on top of things and what's new and up and coming. I mean, how do you do this?
Yeah, no, it goes back to the old saying, if you hang out around 4 other successful people, you're most likely going to become the 5th. You start picking up their habits. And it's the same thing if you're just constantly communicating with other top agents. You're more in tune with the market. It's good to get other perspective, but they kind of rub off on you too.
So 6, I'll say, if you don't have a KPA on yourself to understand what your superpower is and what your kryptonite is, if you understand the analogy, we should talk. But number 7.
They work harder than anyone else.
That's the one you were talking about. Yeah. Why?
They're the Kobe Bryants.
Yeah.
There's a big, I think you played this video at one point in a meeting, but there was Kobe Bryant sitting at the other end of the floor. Some guy walked into the gym, started shooting baskets, and Kobe just kept on going. And the other guy quit before Kobe did. And he said, "Hey man, what was driving you?" And he goes, "I'm not going to let somebody else outwork me."
Yeah. It's a mindset.
Yeah.
All right. So let's run through some of these other updates here. Hang on, my screen is, there we go. All right. These 3 US states have the most vulnerable housing markets by far, not Texas. And here's why I want this article on here, not to tell you which 3 states are most vulnerable. It's really just a conversation, which by the way are New Jersey, Illinois, and California. There's 2 conversations in this article. One is it's not solely related, but it's directly related to unemployment. And if you find, where is it? I lost my place. Okay, here we go. The markets included in places like Brooklyn, where the unemployment rate is well above the national average and housing costs exceed 102% of local wages, the highest in the nation. Of course, they're going to remember how I said we're the last in and the first out. Our unemployment is as good, if not better, than the national average. Our affordability is almost equal to minimum wage can almost equally buy a minimum or median priced house. Let me rephrase that. Median wage can almost equally buy a median priced house, which is affordable, right? That's what affordable is defined as. But, you know, I think this is where, Jim, we're going to come on here and scratch our heads going, all these national news media articles, and we just aren't having the same experience.
Yeah.
Yeah.
Well, we saw this during the last Great Recession, right? Texas, we were down, but not like the rest of the country, us in Raleigh.
All right. The next article is missing. There it is. Risk of home price corrections in DFW makes it better to rent than buy. What do you make of this?
This is always a big debate, and looking at your home ownership from a business perspective, but it just depends on who you talk to, what you're reading, right? I think we've seen, I read something about 2 months ago that said the average person in the Metroplex is spending 30% or more of their income on rent. Well, if you look at just what it takes to buy a house, at that point, I would argue that it's going to be better for us to go out and buy a house, start building into your future, right? Rather than renting. But I think it all, I don't know what to make of the numbers, how they pulled the data.
Here's the thing that I think, this is my perspective on this, is, the cost of buying real estate went up drastically during the pandemic. Like, you can't just put a minimum down and get into a house in the last 2 years.
Mm-hmm.
We're moving back to that. But I think there's still some PTSD of people trying to buy houses that just couldn't figure out how to make the thing work, right?
Yeah.
Yet rents went up too. And they went up at the same rate the cost of buying real estate went up. So somebody spending, we used to do comparisons of a 3-bedroom apartment, which was $1,500 a month. Nowadays, it's probably like $4,000 a month, right?
Yeah.
And the higher those rents go, the more it drives people back to the real estate market. There's another article over here titled "Texas Housing Market Shows Signs of Cooling Down After the Pandemic Drove It to New Heights." Exactly what we're talking about. But some declines, they're still quoting April. I mean, this is not current, right? Like, it's that's why I don't like some of these articles, because they're so far behind, and meanwhile, I'm looking at numbers going, hey, I can't even predict where we're at right now because we're kind of waiting to see, right? But there's a comment in here, if I can find it real quick, that says, meanwhile, here we go. Meanwhile, builders in some parts of the state pulled back on construction of new single-family homes after 2 years when construction surged. Building permits fell by double digits. So that's information we need to know. Like, building permits are down, but I also am showing you that the analysts are really betting on big on home builders in the future, which I think is a really strong thing for our industry. But it really is, this is what I think is a bigger part of the story, Jim.
Mm-hmm.
It's saying a recent uptick in potential buyers motivated to escape the state's ballooning rents. At some point in time, you resent paying a high dollar amount in rent. And I get that it's a reality for some, but owning a house is still an American dream. And when you're writing fat checks to somebody else, at some point in time, somebody's going to have a conversation with you. And I hope it's one of our agents.
Mm-hmm.
What do you make?
No, I think you're exactly right. And I think if you're looking for, well, how does this pertain to my business? Exactly what you just said. You find all the renters that are out there and you start marketing to them. Go door knocking, call, whatever it is, get them on a good mail campaign. But these are the things that you should be doing in your business and what we're talking about right here. But you're exactly right.
There you go. All right. Last article was, where's the headline? North Texas home affordability is dropping, but here's who's priced out. I hate these headlines, but the truth is, okay, so the median income of 60,000, median home price 360. That was what they're basing Dallas Fort Worth affordability on. So you got to ask yourself, the clientele in your database, if I took a sample of we'll do Elon Musk Twitter math. We're going to take a subset of your sphere of influence of your 100 people. What's the average income of that 100 people? Is it more or less than $60,000? I'm going to guess most of our agents, it's more. And then take a same snapshot of the price house they live in. I'm going to guess it's averaging higher than $360,000 for most of our agents. But even if it's not, it probably means they're in a place of affordability, right? But it's interesting to kind of know what they're basing the numbers on. But there's another thing down here, which I find really interesting, and I'm just going to kind of end us on this. Drilling down into DFW, it says DFW remains affordable for its many IT professionals whose numbers rose almost 30% in the last decade. They earn an average of $97,000 and will need an average of 3 to 6 years to save up for the down payment. Okay, at $100,000, you need 3.5 years to save up for a down payment. It depends on what they're paying in rent.
Yep.
Right. Yet IT is a big part of our workforce. Dallas Fort Worth is also one of the best options for those who work in the healthcare industry, as they earn an average of 105 and can have money ready for a down payment in about 40 months. I find 40 months and 3.5 years to be pretty close to the same amount of time, but we're going to leave it there for now. The healthcare, IT, I mean, what do I do with this information as a real estate professional? Do I target these people? Do I network with these people? Do I is this part of my my business plan for next year? Do I have some smart data around IT or healthcare? The biggest salaries in DFW are lawyers and judges, top managers like marketing, finance, and sales managers, and air transportation workers with an average income of above $120,000. These professionals can save for a down payment in around 2.5 years. Okay. And the other end of the spectrum, most of the employees in the material moving sector, the most popular sector by number of employees, are priced out of home ownership in Dallas Fort Worth with an average income of $35,000. It's below the qualifying income and not enough to save up for a down payment within 5 years. No wonder we have supply chain problems. But what do you make with this? What would you do with it?
Yeah, no, I think you do a couple of things. You can look at it from the standpoint of what do we have the most coming into the Metroplex right now? You've got a lot of data centers. You've got a lot of medical that's in the area. I mean, if you just look at, if you're in Rockwall County, you're surrounded by medical, right? You see a lot of those industries right there. And even going down to the logistics, what do you have a lot coming into the Metroplex? You have more logistics coming in to the Metroplex than anywhere else.
Talk about that.
Yeah. And so the more jobs you have, it's going to drive those wages up. But I think you're exactly right. If you wanted to really dive into it, if this is how your mind works, then this should be in your business plan. If it doesn't, then it doesn't, right? But have some smart analytics, have some predictive analytics. This information on occupations is readily available out there for you to go get. But will you use it? And will you use it properly is the biggest thing. And will you work hard at it?
There you go. So I know we're going to do numbers again in sales meeting tomorrow. And we're going to drive down a little bit more. But Jim, this has been fun. We're in the same room, sitting across the table from each other. I don't know how you got the better lighting and I didn't, but somehow it is what it is. Have a good one, guys.